Imagine two remote executives. Both earn an identical salary, let's say $185,000 a year. Both pack their bags, legally relocate overseas, and work entirely online. Look at this split screen. On the left, one executive legally preserves a substantial portion of their wealth over the next decade. On the right, the other executive is buried under a mountain of overlapping tax bills from multiple countries. Let's look at how the executive on the right ended up there. We'll call him Julian. He's a technology director who decides to relocate to Southern Europe for a better climate and a lower cost of living. Julian secures a digital nomad visa. He makes a very common, very expensive assumption. He believes this visa automatically determines his tax status. Immigration laws and tax laws are separate legal frameworks. A visa simply grants you permission to physically live in a country. It carries no weight in determining where you owe the government money. Julian settles into his Mediterranean lifestyle. He figures that because he holds a passport from his home country and physically lives thousands of miles away, his finances are insulated. Then his employer reaches out. Human Resources starts asking pointed questions about payroll compliance based on his new physical location. Suddenly, Julian realizes his home country still expects annual tax filings. At the exact same time, the local tax authority in Southern Europe begins investigating his income to see if he qualifies as a tax resident there. Crossing a border does not automatically sever existing financial obligation. Usually, it simply stacks new legal liabilities directly on top of the old ones, creating overlapping claims on the exact same income. Julian imagined a streamlined life abroad, free of complications. The local tax authorities, however, view his situation through a rigid bureaucratic lens. Many expats rely on the 183-day rule, thinking that if they leave a country before spending 6 months there, they are protected from local taxation. The calendar is rarely the entire answer. Authorities evaluate you using the center of vital interests. A scale weighs days spent in the country against your permanent home, family, and corporate ties. If these anchors are heavily weighted elsewhere, you're classified as a resident. Tax residency is determined by the gravitational pull of your life's assets and relationships, not by checking the GPS coordinates on your phone. Governments capture income through three funnels: a residence-based, territorial, or citizenship-based systems. Conflicts arise when these collide. If a US citizen moves to Europe, both nations may tax the same dollar, creating friction. Treaties act as bilateral referees. They establish a hierarchy that designates which nation has the primary right to tax a specific salary or dividend, protecting the individual from being drained twice. This legal web extends into personal investments. Julian quickly discovers his cross-border stock portfolios are suddenly subjected to aggressive dividend withholding taxes. And then there is his overall business structure. The simple sole proprietorship he set up back home is legally incompatible with the corporate tax laws of his new host country. Ignoring these mismatches isn't an option. Modern international banking operates on strict transparency. Foreign financial institutions now proactively share your compliance data and tax residency across borders. The global financial system is a tightly woven web of treaties and automated reporting. Operating under the radar is an outdated assumption that usually leads to steep financial penalties. Facing this reality, Julian pauses his plans to buy foreign real estate. He realizes that international property ownership carries severe hidden liabilities, from local transfer fees to unfamiliar inheritance laws. He also uninstalls his domestic DIY tax software. A program designed for one country cannot navigate the conflicting legal codes of 2 or 3 separate jurisdictions. Look at this panel. This is what the executive from the very beginning, the one who kept his wealth, did right. Wealthy expats build a localized cross-border advisory team before they ever pack a box. Long-term wealth preservation is the result of meticulous planning. It requires a clear understanding of how distinct legal systems overlap and influence one another. International mobility offers extraordinary flexibility and opportunity, but true financial security comes from understanding these complex frameworks long before you step on the plane.